a central bank normalizing rates is a positive message for growth risk assets. And I'm glad that we've got to that stage, because it was getting a little bit, let's say, tedious to talk constantly about the Fed from 2008 onwards for when they'd start to move rates and what would that actually mean. At the moment, our recommendation is to be neutral India with a bit of a cyclical bias and an underweight in staples and underweight in healthcare and IT because of concerns about US policy. And so for the balance of the market, that's 60%. We've got a cyclical bias. But the cyclicals we're finding in India are more expensive than the cyclicals we're finding in other emerging markets at this point in time. Demonetization obviously had an impact on the consumer as well. So I think it might be towards the end of this year that you're really seeing the main cyclical benefits, and then you would get positive earnings revisions. Now, if we take these sectors such as IT, healthcare, there are fundamental reasons why people are cautious on earnings there. So I think you blend these things together and you don't get as powerful a message on earnings as you might have hoped. We've got a base case of another 9% return out of EM, and so India would perform in line with that. And so that would be, a 20-odd% return for the full calendar year. I'm comfortable with the China story. I think when I talk to investors that they started the year very pessimistic, they felt that there were going to be a fading in the stimulus, and the data that's coming through is very strong for autos relative to expectations, for property relative to expectations, and the industrial data, particularly profitability, is better than expectations. So we're very bullish on China.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.